So it's being speculated that futures positions are getting dumped every single day in order to push the price of Bitcoin down before Wall Street buys the ETFs. Well, this is corroborated by the fact that on weekends, as you can see here, marked by these red circles, liquidations in the futures market are very few and far between. So this gives us a bit of a hint as to what Wall Street might be doing. Either way, if they're doing this, if they're not doing this, the reality is Wall Street's appetite is only accelerating. So all 10 Bitcoin ETFs combined saw a record $1 billion in total inflows just yesterday on March 12th, 2024, a Tuesday. That marks the first day ever that the total net inflows into these 10 spot Bitcoin ETF products was over $1 billion. Now, to give you some kind of sense of relativity for what those flows mean, that's roughly 13,700 Bitcoin a day at yesterday's rate with current prices. Only 900 Bitcoin are being produced on a daily basis, so Wall Street is buying about 15.2 times more Bitcoin than is being produced. This is remarkable, and you could bet that this passive flow into Bitcoin is only going to continue accelerating as more brokerages come online and start offering these products. Demand ramps up. Again, I've said this in videos and blogs time and time again on my Twitter, that as these products become more popular, as more people see that Bitcoin Sharpe ratio is better than any asset year to date. It is better, not only risk-adjusted returns, but better absolute returns than any asset year to date. Portfolio managers, financial advisors, the world over are going to begin recommending Bitcoin, and these ETF inflows are only going to accelerate. So this is the first $1 billion inflow day, but it certainly, by every measurement, will not be the last. The next thing on the block is that Janet Yellen said inflation isn't as transitory as they first expected. Take a listen to this clip.
In 2021, you did say that inflation was transitory. Do you regret saying that now?
I regret saying it was transitory. It has come down, but I think transitory means a few weeks or months to most people.
So Janet Yellen says she regrets saying inflation was transitory. Ouch! But it might be a little bit too little too late if we're being honest. Guys, this is the 9th month in a row that CPI inflation has been stuck above 3% and hasn't been able to fall underneath it. Now, you guys know the long run historical average for price inflation. The Fed tries to keep it at 2%, which in and of itself is disgusting. Modern monetary theory, this notion that if prices didn't go up, people would stop buying things. Unfortunately, that is the theory around which our economy is constructed and our monetary policy is conducted. You'll see here, I created the range between 2.5% to about 1% that the Fed usually likes to keep CPI inflation. I highlighted that range with the dashed line in light blue there. And I put up CPI and core CPI. Now you'll notice both of these, right? CPI, of course, includes food and energy, so it's a little bit more volatile. Both of these things have been stuck above 3%. The Fed hates that. It doesn't like that very much. And of course, what that has done, that has led to rise in the slope of price increases. Of course, that makes sense, right? If price inflation is always around the 2% area and for more than 3 years at this point, price inflation has been above 3%, of course, the rate of change of prices is going to rise. And people are noticing it, and they're not liking it whatsoever. A new study showed, well, this is not a new study. It's been a continuous poll given by Gallup, and essentially they ask American voters, what is the number one problem that you're facing? And the percentage of Americans mentioning economic issues as the nation's most important problem has risen to 30%. And in fact, it is the most important issue for most Americans. You'll take a look at this chart here. As of February 2024, of course, at the time of this recording, the economy in general, economic problems, of course, including high cost of living and inflation, the federal budget, taxes, unemployment, that remains the key issue for most Americans. And of course, the only way to get this down is through a recession. The only way to get price inflation down after it's sticky is through a recession. Janet Yellen has admitted as much. She says that inflation decline might not be smooth. And that's a pretty light way of putting it. Take a look at this chart here. This is the last one I'll leave you with today. Recessions are what help inflation get unstuck. So I highlighted every single period back to the 1990s where price inflation was elevated above the Fed's desired target. You'll note that in roughly around that late 80s, early 90s timeframe, price inflation was around 6% yearly. The Fed didn't want it there, and you'll see in those red bars, a recession is what helped get it unstuck. A recession obviously led to people spending far less. Well, people spending far less is what leads to a recession, but you get my point. An economic slowdown, people spending less, that makes inflation go lower. Of course, people get thrown out of their jobs, but that's besides the point. You'll see here the exact same dynamic was at play during the dot-com bubble. Price inflation was around 4%. The only thing that helped get it unstuck and fall back down to the Fed's desired target at the time was a recession. You could see in those red bars. And then, of course, the Great Recession. Price inflation was above 4%, between 4% and 6%. Terrible. The only thing that helped get it unstuck was a recession. And of course, in 2020, the exact same thing happened. And that's going to be the same case here, guys, right? For 9 months now, and I put red dashes there as well so you could see the range. We've been stuck above 3%. And the reality of the situation is we're going to see a recession in order for this to come down, which means unemployment, which means people spending less. Cycles resolve in the exact same way. And while people believe that, oh, this cycle might be different, we may be able to get price inflation back down to the 2% target without a huge spike in unemployment, it's just not the case. It's never happened. I have a pinned tweet. You could see in my profile that the mentions, the news headlines of a soft landing always surge. They always surge in anticipation of the resolution of an economic cycle, but it always ends up being hard, i.e., people get thrown out of work, prices fall through the floor, and it resolves in more and more fiscal and monetary stimulus, which could also be one of the reasons why there are record daily inflows into Bitcoin ETFs. More and more people are recognizing that Bitcoin is their hedge against what is inevitable, and that is fiscal and monetary stimulus, monetary debasement, in order to stimulate the economy and get people back on their feet after the recession that we all know is coming. So that's it for today. Relatively short one. I want to keep it dense so you guys watch all the way through. Make sure you guys download Theya, your keys, your Bitcoin. Now is more important than ever to get your Bitcoin off exchanges. Don't buy these ETFs. Don't give your Bitcoin to BlackRock. You need to use Bitcoin the way it was intended. So buy Bitcoin, get it off an exchange with Theya. You can download it today on the App Store. Talk to you guys soon.